Okay, so the principles that again we've mentioned these, so let's just review. Um, Consistency. Okay, so this first one has to do with uh, applying the same procedures and the same methods across periods. Okay, uh, what happens if we don't do that? What do you think would happen? Anyone have an opinion? It would make it difficult to compare different periods. Okay, if you're changing the rules every period, then you can't really look one versus the other because they're all based on different kind of methods. Okay, so we want to be consistently applying the same methods and procedures from period to period, and it allows us to better compare. Okay, so uh, consistency. Okay, what about disclosure? So disclosure means that your business has to disclose enough information about what you're doing, what methods you're using, what's going on with your business, what accounting assumptions you're using, so that uh, whoever is reading your financial statements, they can make an informed decision. Okay. Now, this can also be abused. Okay. So Enron, which was a big financial scandal, they actually disclosed kind of some of the shit. They in within their financial statements, they had stated what they were doing that was shady. Okay, so it was just so obscure and it was so hidden. It was like they kind of buried. It's like what is it called? Flooding the zone. Okay, I think this is what with social media and all that. They had flooded the zone. Okay, they had put so much information in their disclosures that the material thing that mattered, these kind of uh, the accounting tricks that they were doing, they had done some very aggressive accounting. It was hidden. It was like it was kind of buried, and you'd have to really beforehand kind of know where to find it. Because if you didn't know, is it's going to be hard to discern what they were actually saying. Okay, so disclosure, there's some balance too. Companies can use disclosure as a way of kind of flooding the zone and like bearing what they're actually doing. Okay, so maybe if we have time, we can talk about Enron. They did some very, very, very aggressive things um, that were actually allowed under GAAP. Some of it. Um, so yeah, maybe if we have time later, we can talk about that. Um, okay, materiality. Uh, it's not practical for a business to report everything down to the exact dollar. And oftentimes it's not even possible because you're going to be using assumptions, right? For like how much people are going to bring back for warranties. We're going to learn about some of these assumptions. Um, or like in the next, or I guess chapter 8, we'll learn about with receivables. You're going to assume what percentage of them are going to like not pay you, right? Some of your customers may not end up paying that receivable. They may go out of business or just say screw you and not pay you. Um, but that's going to be based on an assumption. So there's a lot of things that we're going to start seeing, especially in the next several chapters, that are built on assuming things. Even depreciation, we already saw that, right? You assumed a certain uh, useful life. You assumed how much the residual value was, right? These are just assumptions that you're making. They're not actually necessarily going to work out, right? So a lot of things in accounting are built on assumptions, and so it's again not practical or possible to get everything to be exact. So what the materiality principle wants you to do is just uh, make things materially correct, meaning that uh, they should be close enough such that someone that's reading the financial statements wouldn't change their mind. Like, let's say you were looking at Amazon, and they have hundreds of millions or billions of dollars of inventory. If they were at $10,000 off or $50,000 off, it's not going to matter because it's such a small percentage of their inventory. But if you were running a little convenience store and you were $50,000 off, it would be material, right? So materiality is going to depend on the size of the company. Okay, so So yeah, I guess the principle here is you're not expected to be perfect, but you're expected to be materially accurate. Okay, and then conservatism. This is one I think we've talked about several times. In general, you want to underpromise in as per U.S. GAAP. You never want to overstate assets or equity. Okay, so whenever you have a discrepancy between two different ways of valuing an asset, you're gonna always choose the lower one. Okay, or if you're trying to say, have I earned this revenue or not? You're gonna err on the side of not recognizing it if it's ambiguous. Okay. Or if there's an expense and you're not sure if it's incurred or not, you would incur the expense because that's going to lower your equity. You don't want to not include an expense that should be. Okay. So again, you don't want to overstate assets. So you want to avoid assets being too high, or you don't want equity to be too high. Okay. So those are the two things that conservatism is trying to achieve. Okay, yeah. So I think we talked about this, like R&D. That's like a classic example of conservatism where it could be argued that R&D gives you future benefit and should be an asset, right? And you should kind of amortize it over time. But US GAAP is conservative, and so we expense all R&D expenses, research and development expenses. Yeah. So look, how do you overstate equity, right? How is equity going to be overstated? Um, Contributed capital is really just a fixed amount, like it's your investors are going to give you some amount of money and they're going to get shares. So that there's no real risk here. Okay, contributed capital. But within retained earnings, there's revenues minus expenses. Dividends, that's also kind of a fixed amount, so there's no real risk there. The risk is that you're going to recognize a revenue that you didn't actually earn, right? So in order to avoid this being too high, equity being too high, you don't want revenue to be overstated. Okay, and the same thing with expense. If you have an expense that should be, but you don't include it, that's also going to end up overstating equity, right? Because this is a minus sign. So any expense is going to cause equity to go down. So you're more willing to do that. So if an expense is ambiguous, you want to recognize it. If a revenue is ambiguous, you don't want to recognize it.